what we did was we completed the cash flow last Saturday, revisited and completed the cash flow, and then I took care of what you call it as going through the entire, at least the balance sheet part of the annual report. There is a P&L part of the annual report also which is there, which I asked you guys can sort of go through it, etc. Now, there is a companies present your balance sheet, companies present your P&L statement, etc. and I said you can get to know about the health of the company by looking at the schedules and the whole lot of things, perfectly fine. But there are certain other things which you basically sort of can interpret from that kind of a data that is there. For example, let us say that you are a creditor, you are simple, you are a loan provider for the company, you are basically what you call it as loan provider. If you are a loan provider, or what we typically use in finance, basically what we say a debt provider in the company, what are you interested in knowing? What are you interested in? If you are a debt provider in the company, what will you look for in that company? Credit rating, credit rating. To arrive at a credit rating, they will have to look at some things to arrive at a credit rating. We will talk about credit rating. Profitability of the company, agreed, perfectly all right. Yes, Rishabh? Ability to pay back the loan, etc. Balance sheet, what aspect in the balance sheet? Balance sheet is too big. Profit or loss of the company, perfectly fine. So, assets, turnover, a lot of things. Now, if I have to, cash is fine, cash is one aspect of it, cash will result into cash. Now, let us see, if you are a debt provider, what are the two aspects as most of you said? I am interested in the servicing of the debt. When I say servicing of the debt, the timely payment of interest and the principal back. Supposing I will say that there is what is called as, there is a loan provider to the extent of about 100 lakhs. Now, this 100 lakhs is to be repaid over a period of what you call it as, let us say 10 years. And this 100 lakhs has an interest rate as a coupon rate, let us say of 8%. Now, what are you interested? If I have to provide that loan, I am interested in two things, whether your company has the ability to service the loan as of now. Service the loan in the sense, let us say your company has the ability to pay me the interest first of all. Now, you can say that, sir, we cannot do it from the past record, because past record you had an investment and you had X amount of profit. Moment you make this 100 lakhs investment, then what happens, the profit is going to increase further and somebody can get more profit and we can look at it, perfectly fine. But moment you make an investment, day one the clock is not going to tick there, in the sense in terms of performance, the clock is going to tick for you because money is gone out for you, whereas for the company the clock is going to tick only when they start getting return. Because for example, I will borrow 100 lakhs to put up a factory. So for me to create that establishment, it takes about a year and a half. For me to reach a steady state, it will take another year and a half. So 3 or 4 years is what I am looking at. So I, as a debt provider, I am not interested in that. I am interested in what is called as recovering that kind of a thing. Imagine there is no what is called as a what do you call it as an interest holiday or any of those things are there. So what are you looking at? You are looking at some aspect like what we call it as, first thing, whether the profit what the company is earning is sufficient to basically to pay my interest, first thing. Let us look at the principal later, because principal is pledged against a particular asset. So what do? You will say, I will always look at what we call it as typically the interest coverage ratio. That is, whether the profit what the company is earning is sufficient enough to pay the interest, or how many times, what is the kind of cushion. For example, in the past year, I will say the profit before interest and tax, I divide that basically by my interest expenditure. Now, this will tell me how many times is the profit? For example, my profit is 10 lakhs, my interest is 1 lakh. Now, I will easily say my profit as of now I am earning is about 10 times the interest payment ability. If the profit is 10 times the interest payment, then even if there is a little bit of a problem in the company, even if the profit goes down sufficient little bit, but still my company will be comfortable enough to sort of service the loan or service the interest part of it. That is what we typically call it as interest coverage ratio. My writing has become little legible today, but still, you know. So, we call it as interest coverage, that is the profit sufficient for you to cover that particular interest part of it? That is what we see. Now, the other aspect what I look at is, we will look at even further, if I have to say what we call it as debt service coverage, or what you call it as DSCR, debt service coverage. So, when I say debt service coverage is what? In principal repayment also. So, I will say either the profit before interest and tax is sufficient enough to repay my interest plus whatever part of the principal. Principal due, whatever part of the principal amount that is due, because out of the 100 lakhs, part of it is due this year, whatever part of the principal that is due plus the interest, is my profit sufficient enough to pay that? So, I will say that is what we call it as DSCR, that is debt service coverage ratio, whether your company has the ability to repay that debt, whatever is due. Now I will say this is based on the past record, yes, this is based on the past record. Now, based on the past record itself, if you are comfortable, then if I infuse more money, if you are expanding, if you are making more profit, then the probability of paying higher is going to be far higher. So, I am looking at the past record and making an estimate whether you have the ability to pay, or is it little risky. Supposing you make an 100 lakh investment and the project is not taking off at all, then what happens? You may not even service. So, at least are you able to service? As a debt holder, I am interested in getting my money back from the company and the interest from the company. So, that is what I will look at. Am I with you on this? Agreed. Now, we move further on this. I am going to tell what I am trying to talk about is the basics of analysis, what we call it as. Typically, we use it something called as ratio analysis. That is what you would have understood. Ratio analysis is a one important aspect in basically financial accounting. Now, analyzing the health of the company, all these days till date, I was telling that you look at the P&L and the balance sheet, you have the health of the company. Actually, no. When you do the ratios, you get the first cut, what you call it a first cut, you get only the first cut idea about the health of the company out there. Because in a balance sheet, everything looks, balance sheet is balanced, but whether the company has the ability to repay the debt, nobody knows. Only if you do these kind of things, at least it gives you some rough idea, ballpark figure, then you go and do the further analysis as you go along out there. That is what we call it as ratio analysis out there. Now, let us look at, as a debt provider, I am interested in something else also. We will come to that part of it later. Now, let us move to what is called as your equity provider. Your equity provider. If you are an equity provider, what are you interested in knowing? Profit, agreed sir? Company value, how do you know the value? How do you analyze? That is what I am asking. How do you analyze that? See, these are qualitative statements. Convert that to numbers. Profit, asset I have. Simple thing, sir. You have put, for example, I will say, based on what Anshuman said, I have a profit of 10 crores in the company. Is it good? Is the company good, worth investing or not worth investing? I am saying profit is 10 crores, forget about liability, why are you bothered? Profit is 10 crores, it is worth it. The capital is 10,000 crores, profit is 10 crores, is it worth investing? So, what do you look at? You look at return on your investment, right? Now, you understand the reason, because just the profit alone, Absolute figure does not give you the entire picture. Now, I will look at what I typically call it as return on equity, ROE, return on equity. That is, I am talking about equity holders. What is the return for the equity holder? The return for the equity holder basically when we say is nothing but net profit. Because equity holders get what? Only the profit out there. Now, what is their investment? Their investment is whatever is the amount of equity they have invested. Now, there was a question in the quiz also. I think the B part of it. What is the investment of the equity holder? Is it the money they have invested in the shares or is it something else also? Basically, what you say, you are right, equity contribution plus all the money that belongs to the equity holder, that is the entire pool of the reserves and surplus, what I click, that includes your retained earnings and so on and so forth. I had a question, tangible net worth is, net worth of the equity, net worth is nothing but whatever money you have invested in share capital plus all the reserves and surplus. Ideally, I would expected reserves and surplus. If somebody has written retained earnings also, I will give you marks, do not worry about it. So, it is perfectly fine, that is not a problem, right. So, that way what we are looking at in the, because the idea is, do you understand the concept? Yes, now you have understood the concept. So, that is all what I am looking at. I am not looking at the precise what do you call it as spellings and other things. So, do not worry about that. Now, what we are looking at is, we are looking at the total investment. Investment when we say, if you look at a recall, if you visualize a balance sheet, equity is let us say 10,000 shares of 10 rupees each, capital is, share capital is 1 lakh. But what is the investment of the equity holder? Investment of the equity holder is not only that 1 lakh, the past over so many years, whatever money that has accrued to him but not paid to him, that is getting added to the capital, what we call it as reserve and surplus. So, when we say in this particular case, what is his investment, return on his equity, we will say he is basically the share capital plus what you call it as reserves and surplus out there, or if I have to put it in one simple word, I will say the total net worth of the company. Of course, you express it in a percentage, you multiply it by whatever 100 or whatever it is, you can get a percentage out of it, you express it in the form of a percentage. So, what will give you? Supposing I say my profit in the company, net profit in the company is 10 crores, my investment in the company is whatever, my share capital in the company is about, let us say 60 crores, the accumulated reserves and surplus so far is about 20 crores. So, the total investment becomes 80 crores, 10 crores is the capital, 10 crores is the profit, 80 crores is the capital. Now, you know what is the return on your investment out there. That is what we call it as return to equity holder, not an investment, return to equity holder. When we say investment, the total money that is invested in the company. When we say total money invested in the company, it includes your debt holder also. We will come to that a little later, we will not touch upon that as of now. Now, Anshuman also mentioned one more aspect out here. He said, when we are looking at the return, profitability part of it, I will also look at what is the return on the asset out there. Now, your equity might be huge, part of the equity is parked somewhere, that is, it is comes, and if you visualize the balance sheet, at the asset side of the balance sheet, what happens? Fixed asset, then the second head is, who said investment? Second head is investment, third head becomes your current asset, fourth head becomes your miscellaneous expenses and losses, that we will leave it there. Again, let me repeat, first head is your fixed asset, fixed in nature. Second head is where you are parking the money, investments out there, all your investments. Third head becomes your current assets out there. Let us keep only 3 heads as of now. So, you have raised about 100 crores capital. I do not need the 100 crores as of today. So, I am parking all the money in various investments out there, perfectly all right. Then when I am looking at the return, what is the effective money that is invested in the assets for you to actually get operational return out there. So, what do I do in that particular case? Sometimes I also look at return on assets out there, or return on what I call it as fixed assets also I may do. Basically what I do, I am looking at basically your return, that is the net profit, and then your denominator will be either total assets if you want to do it for total assets, or if you want to do it for fixed assets, it will basically be for fixed assets. That will give you, I have invested 10 crores in the machinery, fixed assets, I am getting 10 lakhs as profit. Now, for the investment that I made, suppose you want to take over that business and then run the business, you are not taking over the investment. Investment is a separate thing. You are taking over the core aspect of the business. When you want to take over that business, you are interested in knowing what is the return you are earning on the fixed asset. That is the investment that has gone directly into the core operations of the business. Am I with you on this? So, these are some of these, what you call it as, typically we look at the ratios per se. So, I will tell you, I will compare what is the return on asset, what is the return on equity, return to equity holders, etc., and then basically analyze what is the performance of the company. I can take two companies. Imagine you have the option of investing in one of the 3 or 4 companies out there. When you have the option of investing in one of the 3 companies out there, I can do these kind of ratios out there, and which is giving me a better return. One company might give 100 crores profit, another company might give only 5 crores profit, but the return on investment in the 5 crore profit might be far higher compared to your 100 crore profit per se. Am I with you on this? So, this is what will give you some kind of a picture. So, what we looked at? We looked at for the debt provider, we looked at for the equity provider also, some of it. Am I with you on this? Now, further we go on. We will continue this in the next class also, tomorrow also a little bit. Tomorrow please bring the annual report. Please bring the annual report. We will try and see if we can calculate from there. The next aspect what we are looking at, the annual report is what is there in the yellow manual, what I have given out there. Now, the next aspect out here is, for example, we said I looked at the return, I looked at the equity holder, I looked at from the debt holder, etc. Now, imagine I am what is called as a vendor to the company. Vendor, you call it supplier, whatever it is, to raw material to the company. What are you interested in knowing? Whether I will make a payment properly. Beautiful. Now, how will I know whether I will make a payment properly? Now, you are right, Mr. Baba, but how? Ability to pay capacity, qualitative, convert it to number. Assets is, you have lot of assets, all fixed assets are there. Bank account is there, bank account will not have money, you will always not keep money in the bank, because you should keep only 2% out there. Yes, Rishabh, 1 second. Accounts payable. How many days the company will take to pay? Creditors. Yes, Joel. Liquidity, accepted. Now, let us look at it. Now, how do you pay your suppliers? Let us understand the logic. See, one is, if you in the textbook, I think I am not really sure about the page number. I can give you the page number also. It will have all the formulas listed. You can mug the formulas. If you mug the formulas, then there is going to be a problem. So, understand the logic behind it, easier for you to look at it. That is the thing. Now, that is the thing. Now, let us look at it. How do you pay your suppliers? I will not pay my suppliers unless I get money on the sales out there. These suppliers are basically what you call it as creditors. What happened? Okay, fine, no problem. Now, the money, people who have to pay me money are called as debitors. Debtors are whatever we call it as debtors out there. Accounts receivable, bills receivable, so on, creditors, etc. Now, I will have to pay only from these fellows. Only I get the money, I will pay these fellows. So, what do? I need to know on an average how long does it take for your company to pay, as well as what is the, you might have say I will have a 30-day credit policy, perfectly fine, that is on paper, but in reality how long do you take to pay? For example, let us look at it. I will say in that problem itself, whatever I had given, there was a sales figure out there. Where is the paper? One paper you give me? No problem, don't worry, it is okay, you don't have to. Let us say the sales in the company is about 10 lakhs through the year. through the year what it is. Now first assumption what I am trying to make out here, simple, let us not make it very complicated, let us make a simple assumption. This is the sale which is happening throughout the year. First thing, it is not seasonal, let us assume this is what is the average sale per day. Average sale per day, if I say number of operating days is 365, I will say 365, whatever is the number of days you want to take, that will give you the average sale. What is it? You have a calculator? That will be about, roughly, give me some rough number. Some 3,000, approximately 3,000 per day. Approximately, let us not look at the nth decimal and all, I am not looking at, let us look at approximately nth this thing. So approximately my sale per day is about 3,000 rupees. Now on an average what do? For example, on the 31st of March, supposing your accounts receivable or debtors in your books of accounts is, let us say, about 50,000 rupees. Is about 50,000 rupees is the debtors in your books. That is equal to how many days sales? 5 days. No, it is 3,000, it is not 5 days, ma'am. It is about 16, 17, whatever, some rough number of days. So on an average, let us say, if I say, now I will say average, on an average, what is called as my average debtors out there in the year, average debtors out there. I have averages, I have the opening debtors out there, I have the closing debtors out there, I have last 2 years. My average debtors are an average, the debtors in my books at any point of time on an average is, let us say, 75,000. At any point of time I have 75,000 on an average as my debtors and my per day sales is about 3,000, then what is the number of days amount that is pending out there on an average? On an average, if 75,000 rupees is the basic debtors out there average, my per day sale is 3,000, then 75 by 3 will give you the number of days it is basically taking for you to receive the money. Am I with you on this? Can give me some number, whatever is 75 by 3. 25. Now on an average it takes about 25 days for me to receive my money. Am I with you on this? So collection period, that is what which is called as average debtors collection period. This is what we call it as average debtors collection period, average debtors collection period. Now this gives me, if I am a supplier to your company, I know on an average when do you get the money, only I know on an average you are getting the money on 25 days. So I can expect payment around 25 days if I am supplying to you, because at least under the belief that your company is not holding back the money, right, your company is not going to hold back the money, that is under the assumption out there. So that is one of the first step. Even or if I am a person who is basically saying, who is purchasing from your company, and your company says our credit policy is only 15 days or 20 days it says, but by doing this kind of an analysis I know though your company says 20 days is the credit policy, I can extend it by about 3 or 4 days, make it up to 25. That also gives you a cushion. Every day matters, because every day there is a cost of interest, that also matters. So it is both ways, it is basically workable, sir. Am I communicating? So far so good. So that is what basically this gives you, if you are a supplier out there, this gives you some of these kind of, what do you call it as, it gives you some of these kind of, what you call it as, typically out there. Now on the other way, if I sort of go ahead, that is on the debtor side you looked at. Now on the creditor side I will look at, you have what you call it as, you have your average, what do you call it as, your average creditors, that is to whom you have to pay, whatever yearly average I can take it, average creditors out there. Now I have what is called as my purchases for the year. Supposing I say my purchases for the year is, let us say, is about 7,50,000. Now I know what is the average purchase per day. What is the average purchase per day? This 7,50,000 divided by your 360, I don't know, 360 or whatever number of working days. If you say 350 is the working days, 350. If you say 300 is the working days, 300, whatever it is. How much is it? 20,000 per day? Per day? Pratik? Now 2050 is the average purchase per day. Now if average purchase per day is there, now let us say my average creditors, this number, if we say on an average I have average creditors is about 50,000 in the year. That means what? At any point of time, this is, that is 50,000 divided by your 2,000, that is roughly about 22, 23 days. 22, 23 days is basically what it takes for you to pay. Now as a supplier, if I do this analysis from your balance sheet and past records, I know how many days you take to collect, how many days you take to pay, and I will plan my activity accordingly. Though you might on paper indicate I will pay in 15 days, I will pay in 20 days, but I know on an average what is the time you will basically take out there. Yes, Navya? 50,000 is nothing but average creditors, that is what I have put that arrow out there. Average creditors, average, for example, very simple average. Beginning of the year, last year's closing, you had some creditors. This year closing, you have some creditors. Just take the average. That's all what it. Here I take a yearly average only with 2 figures. You can take a monthly average also if you have all the 12 month figures, etc. Now I just looked at. If you mug the formula, it will say what the formula says. Average, that is opening creditor plus closing creditor divided by 365 into something, I forget, I don't know. So don't go by the mugging the formula. Understand the logic behind it. It's always easier for you to calculate the whole thing. Now further on this, somebody said, use the word also, that is what we call it as typically, he said that, sir, you look at the liquidity part of it. Yes, I require the liquidity part of it. How do I require the liquidity part of it? So simple thing, my liquidity is what? How easily the money can be converted out there. So what is the aspects that you can look at the liquidity? Basically the current asset and basically the current liability. Whether my current assets are sufficient enough to pay my current liabilities. Typically we call this as current ratio. That is how much of your current assets, and that is your current assets is how many times your current liabilities. How will you pay your payables? Payable is a liability. You will pay money only if you collect from the receivables, you will pay. So how much of your current asset? Current asset includes, somebody said cash, and how much money is there in the cash and bank? Yes, everything. Money there that is there in the cash and bank. Money there that is basically that can be easily converted to cash. Your stock of raw material, stock of finished goods, because it is going selling. So your entire current asset pool, how many times is the current liability it is there? If it is, that cushion is higher, then liquidity is better, that is you can always convert and pay. If you look at a typical textbook, it will say 2:1, 5:1, all kinds of ratios, it will say don't go by the ratios. Reason, Pratisha is immediately thinking of 2:1. Now reason, it varies from industry to industry. For example, you are looking at a service industry, your current ratio will be very, very different. For example, let us say you look at Amazon. How many of you buy on Amazon? All of you, I think. What is the current ratio of Amazon? It will never be 2:1. It will be the other way around, because you pay first and then only buy, whereas that fellow will pay the supplier not immediately, much later. So current asset, that is there is no receivable, current asset is 0. Sorry, no receivable out there, current asset is 0, there is no receivable, no debtors, payables will be huge. So it is not 2:1, it is 0 to some whatever it is, it will be some 5 or 6 or 200 or whatever it is. So if you look at Amazon, the number of days they take on an average to pay, their suppliers is about 200 days is the kind of average. Whereas when do you guys pay? You pay immediately. So what happens? There is a lot of liquid cash flowing around. That is where Amazon cloud, they can go ahead and invest and so on and so forth and so on. Understand? So don't look at the textbook, because that textbook ratio had its context when we were a typical manufacturing sector. Where typical manufacturing, you had what you call it as all your reorder level, reorder quantity, economic order quantity, which you learn all those things. But today that kind of a hard and fast number is losing its relevance out there. That is one of the reasons I am not giving you any number per se, but we are looking at the liquidity part of it this way. That is, I will pay all my current asset liabilities through my current assets only. A further refinement of this, what happens is, I will say among all the current assets, what all current assets? There is inventory, there is work in progress, that is all the inventory part of it, there is receivables, there is cash and bank balances, any kind of advance I have given. Now, of all these, can I convert it to cash? Which are the assets that can be easily converted to cash? I can convert receivables to cash. That is, for example, if it does not pay, I can always go and get it discounted. I can do a factoring out there. We will explain about discounting and factoring as we go along. Whereas, I can convert what is called as cash is already cash. The most difficult part of it to convert is basically the inventory which I have, especially the inventory. For example, if you go to the sugar mill, cooperative sugar mill out there, they have stock of about 8 months or 9 months of sugar that is there. Most of the cooperative sugar mills out there in the country. Ease of conversion is not going to be very high, especially whether it is finished goods stock, raw material, it is even worse especially. So, what we call it as, when we say, we will say current asset minus inventory, we call it as what we call it as quick assets. We call it as quick assets, QA, quick assets. Now, I can say whether my liabilities, current liabilities can be met by my quick assets itself, whether that is all my receivables I can discount it from the bank. For example, I have a receivable of about 10 lakhs, I can go to the bank and discount it. I can give the what I call promissory note to the bank, and then bank will give me 9 lakh 50 or whatever is the amount out there. Now, I have got a 10 lakh, the bank will recover 10 lakhs once the payment happens, but as of today bank has given me 9.5 lakhs, that is I need that money. So, that is what we discounted. So, whether your quick assets will be sufficient to meet your current liability. So, when we say liquidity position, we will say a current ratio or we will say a quick ratio out there. Quick ratio is only quick assets and my current liabilities. Am I with you on this? So far so okay? So, what we did, we looked at as a debt provider, simple thing, whether the company is sufficient to pay, has money to pay the interest and the principal, whatever repayment. As an equity provider, you are looking at whether the company is sufficient enough, what is the kind of return on equity they are earning. Please note, I have not touched EPS still, earnings per share and etc. We will do that little later. Third, we looked at on an average, how long do you take to pay your suppliers, how long do you take to receive money from your, what do you call it as, from the on the sales what you have made. We looked at the liquidity position of it. Now, we will go a little more on this and spend some time with the what do you call it as the manual tomorrow in trying to calculate for those companies whatever it is there. Okay? Thank you. We will meet tomorrow.